When it comes to protecting your family's financial future, not all life insurance is the same. For years, people have asked the same question: which is better, whole life insurance or universal life insurance? The truth is, both have their place, but they work very differently, and the one you choose can make a big difference for your family's security and your financial goals. In this video, we'll go step by step through what makes whole life strong, what makes universal life flexible, and the important trade-offs you need to know. By the end, you'll have a clear picture of which one might fit your life best. Let's begin with whole life insurance. Think of whole life as the reliable choice. Once you set it up, it's designed to last for your entire lifetime. No expiration dates, no your coverage is ending. As long as you keep paying your premiums, the protection is there, no matter what. That means even if the stock market crashes or interest rates swing up and down, your policy stays steady. For many families, this reliability brings a huge sense of relief. Another big part of whole life is the premiums. Once you set your premium, it never changes. If you start with $300 a month, you'll be paying $300 a month 20 years from now, 30 years from now, or even 50 years from now. Imagine having a bill that never goes up, even when everything else in life gets more expensive. That's whole life. On top of that, whole life policies build something called cash value. A portion of every premium you pay goes into this account, and it grows over time at a guaranteed rate. Think of it like a savings account that quietly grows in the background, steady and dependable. The great thing is that cash value isn't locked away forever. If you ever need money for an emergency, a business opportunity, or even a down payment on a home, you can borrow against it without going to the bank. No credit checks, no long application process. Now, whole life isn't perfect. The main drawback is cost. Premiums are higher than term life or even universal life. You're paying for stability and guarantees, and those guarantees come at a price. Some people also feel whole life is less flexible. Once you set it up, it doesn't change much. But for many, that's exactly what they like about it. It's predictable, straightforward, and designed to be there for life. Now let's look at universal life insurance. If whole life is the steady choice, universal life is the flexible choice. This type of policy is designed to adapt as your life changes. With universal life, your premiums aren't fixed. You can choose to pay more when money is good and build up cash value faster. Or, if money is tight, you can reduce your payments as long as your policy has enough cash value to cover the costs. This flexibility can be a real lifesaver. For example, imagine you're raising kids and money is tight 1 year. You can lower your payments. Later, when your income grows, you can add more into the policy. It bends with your life. Universal life also allows you to adjust your coverage. Let's say you've paid off your mortgage or your kids are now financially independent. You might not need as much coverage, so you can lower the death benefit to save on premiums. On the flip side, if you want to leave more money to your family or your estate grows, you can increase your coverage. The biggest difference with universal life is the cash value. Unlike whole life, which grows at a guaranteed rate, universal life ties the growth of your cash value to investments. That could mean higher growth if investments do well, but it could also mean slower growth or even no growth if markets underperform. In simple terms, whole life is like having a guaranteed savings account inside your insurance. Universal life is like having an investment account inside your insurance. One is safe and steady, the other has higher potential, but also more risk. That's why universal life often appeals to people who like investing, who don't mind taking some risk, and who want to have more control over how their policy performs. So, how do these two compare on cost? Whole life usually has higher premiums up front. You're paying for guarantees and stability, and that doesn't come cheap. Universal life often starts out cheaper, but the cost can change depending on how the investments perform. Think of whole life as buying a car with a full warranty and lifetime service plan. You pay more, but you know exactly what you're getting. Universal life is more like leasing a car with options. You can upgrade, downgrade, or customize, but the cost may change over time. Cash value is another big difference. With whole life, cash value grows slowly but steadily. You can count on it no matter what's happening in the financial markets. It's like a savings account you can always rely on. You can borrow against it, use it to cover premiums, or even cash out if you decide you no longer need the policy. With universal life, cash value depends on how the investments do. If markets perform well, your policy might grow faster than whole life. But if markets struggle, growth slows down. And in some cases, you may even need to pay more to keep the policy in force. That's why it's better suited for people who are comfortable with some investment risk. So, which one is right for you? Whole life is usually best for people who value stability and guarantees. If you want something you can set up and forget, knowing it will always be there, whole life is a strong choice. It's also appealing for people thinking about estate planning, since the guaranteed death benefit and steady cash value can make transferring wealth simpler. Universal life is best for people who want flexibility. If your income changes over time, or if you want to actively influence how your policy performs, universal life can give you more control. It's also a fit for people who enjoy investing and are comfortable taking some risk in exchange for potential higher rewards. Your stage of life also matters. If you're young and just starting out, the flexibility of universal life can help you adjust as your career and family grow. For families raising children, the guaranteed stability of whole life often feels safer. For people approaching retirement, the decision might come down to whether they want steady guarantees or more investment opportunity. At the end of the day, there isn't a single winner. The best policy is the one that fits your needs, your lifestyle, and your goals. At Emerald Wealth Services, our mission is to make these choices simple and clear. If you'd like personal guidance, visit us at emeraldwealthservices.com to book a free consultation. We'll walk you through your options and help you choose the strategy that makes the most sense for your family's future. If this video helped you understand the differences more clearly, give it a like, leave a comment, and don't forget to subscribe for more practical insights. Thanks for watching, and we'll see you next time.